you some information and some actionable items today that you can take away that will increase the profit, the safety, the value, the cash flow in your business. And we're going to do it by talking about a lot of the myriad of changes that have happened in the tax code, stimulus bills, all sorts of stuff that has gone on. It's kind of amazing, but we've had, believe it or not, nine tax code changes in the past 12 months. 9. I don't know how many CPAs are keeping up with all this stuff, and I don't know how Janine and Bonnie and Shane have kept up with it, but I'm really excited to have them on board because they're all CPA / masters in accounting folks, wizards when it comes to this stuff. And I'm very proud to have them all on the TGG team. Janine being the longest tenured person with us, who came to us after graduating with her master's degree in accounting, has been with us through 2, almost 3 kids, and a CPA and all sorts of other amazing stuff that Janine has been able to accomplish for her clients. Bonnie comes to us for Big 4, and the ability to bring that mindset to bear on what we do here, which is a ton of tremendous experience. Bringing that to her clients and the small business realm is phenomenal. Shane comes from the tax side and really has this deep knowledge when it comes to the tax law and what he does. And I'm going to say he's a bit of a geek like me. He loves to dive into the tax law and just loves to get deep and weird. So we're going to try to do that today in a manner, though, and explaining it in a manner that provides value to you. Because what we do here at TGG is our mission is to make business owners' lives better through excellent financial management. And that means that we've got to look at every angle of this. We've got to look at whether or not we're cutting costs right, whether we're pricing our products right, and we have to have accurate accounting and accurate financials to do that. And what you find is that once you have accurate financials, you can apply all of these great thoughts that you're going to hear today to how you go out and make your life better. So excited to have these guys on today, and excited to go through the government stimulus programs and different tax law changes that have happened, and really get our experts to share with you some actionable items. Again, actionable items through some of the things that we've done through clients, so that you get the most out of this. Finally, what I will say is that in order to get the most out of the webinar, if you've got financials on hand and you can bring them up, something to take notes with, because we'll talk about things to write down as well, that would all make this the most successful possible. In addition, at the end of this, we are going to make available on our website, and we've already sent out to our pre-registered attendees, the employee retention tax credit decision tree. So everyone who is registered got that in the email, and we'll also put the notes down, and a recording will be sent back to everybody. This is what the handout looks like. I'm going to be showing that on the screen. But we'll also be sending out a recording of this to everyone who is an attendee. So you don't need to take feverish notes, really try to pay attention. And what we would like more than anything is your questions and comments. So as we're going through this, make sure that you're putting your questions in the chat, and you can direct them to me, and I will make sure that I get these out to the appropriate expert here as we go through this. All right, let's get moving. 3 minutes of an intro is plenty. We got enough because we got too much stuff to talk about. All right, the first thing that we're going to go into is something that everybody understands and has heard about before, which is this PPP stuff. And I'm going to put this under the category of forgivable loans. So we had PPP1, and now we got PPP2. So Bonnie, what was different from PPP1 to PPP2?
Great question, Matt. Biggest difference for PPP2 is in the eligibility for applications. So to apply for PPP2, you had to demonstrate a 25% reduction in gross receipts in any quarter in 2020 compared to 2019. So there was no revenue reduction requirement for PPP1. In addition, the cap on number of employees dropped from 500 to 300. So I would say those are really the two changes. Otherwise, the application process is exactly the same. And we did actually receive some benefits in the most recent COVID relief bill when they announced PPP2 that also apply to PPP1 in terms of forgiveness.
So can you expand on those a little bit? What was some of the benefits that came out of that last bill that they passed in December related to PPP, the PPP part of it? Excuse me, I can't say that very fast.
Yeah, so I think one of the greatest benefits is that we now have the ability to spend the 40% that's non-payroll on more sort of cost bucket items. So originally, and it's still the same for PPP 1 and 2, that 60% of the proceeds need to be spent on payroll for forgiveness. But now this extra 40% can be spent on almost anything that's related to operations. So we've got these categories: covered operating expenditures, supplier costs, so inventory, workers' comp, insurance benefits. Previously, we could only use rent and occupancy costs for those 4 months. So, you know, if you're a business, professional services, you work from home, you don't have occupancy costs. Now you've got room, you've got 40% that you can include your costs for HR, accounting services, office supplies. I mean, anything that you really need to run the business.
Got it. And what else so what's the timing like on this? I heard that we've got, we have until March 31st of 2021 right now to apply for PPP 2. But then Biden came in and said, well, there's only 2 weeks that we're gonna hold it for really, really small businesses. Can you kind of explain to me what happened with that and where we are?
Yes. So where we are today is, as of now, the deadline to apply for PPP2 is still March 31st. Right now, we're in a period where it's open to any companies in that meet those eligibility requirements that I mentioned earlier. However, Congress almost unanimously passed a bill to extend that application timing to May 31st. So based on Congress's almost unanimous approval, if we get buy-in from the Senate and that passes, we might have 2 additional months to apply. My guess is, and how we've seen everything get rolled out with this stuff, we might find out tomorrow or in the next few days.
Yeah, no, so what is your best advice for people today in terms of if they either didn't get the full amount of the PPP1 to start with, is there a chance they can go get that money back? Because it's forgivable now and non-taxable for the federal side. Can they go back to PPP1 and get more money out of that? And then what do you suggest they do with PPP2?
So, okay, to answer your question, for PPP2, so you don't have to have applied for forgiveness on PPP1 yet to get PPP2. So if you received PPP1, you just have to demonstrate that you've spent the money. So an example of this is, let's say you didn't spend all the money in the covered period, right? Let's say your covered period for PPP1 ended in October. I have some clients where that's the case. So if you didn't spend all the money by October, but you've now spent all the money through February, let's say, you wouldn't be eligible for forgiveness on the entire amount because you didn't spend it in the covered period, but you've still spent the money sufficiently so that you can apply for PPP2. So I have clients where we still haven't yet applied for forgiveness for PPP1, whether it's delays from the bank, it's the biggest reason, and we've already received PPP2 money. So my advice is, if you've received PPP1, if you haven't already applied for PPP2 and you are eligible for PPP2, that needs to happen as soon as possible. And if you're not already talking to your banker, make sure to be talking with them about what their process is like and when they're going to stop accepting applications if March 31st is still the deadline.
Got it. And if I remember right, PPP2 eligibility is you had to have a reduction in revenue of 25% or greater in Q1, 2, or 3 of 2020 as compared to Q1, 2, or 3 of 2019. Has that changed at all, or is that still the same?
One thing I would add that is Q4 could also be included in there. So any quarter 2020 compared to 2019. Oh,
okay. So that could open it up. That could open it pretty significantly. All right. So I've got a couple of PPP questions in the chat, but I'm going to answer those at the end because they're pretty specific. So I want to make sure we're addressing those, but I want to get to enough time to get to some of these other things. So Shane, I know you've really dove into this employment retention tax credit, and I think one of the unique things about it was if you took PPP1 in the original CARES Act, you couldn't get this tax credit on payroll taxes effectively. But with the new bill that came out in December, you could. And did that get changed at all in the latest Biden $1.9 trillion stimulus package that just got passed a couple of weeks ago, Shane, or are we still now we can do both?
So what happened in the late December Act was Congress passed it. And so essentially, just because you qualify for PPP and took it doesn't mean you're disqualified for the employee retention credit. So you might be wondering, okay, well, what expenses are still qualified for the employee retention credit? And so basically, if you've got qualified wages that you used for PPP forgiveness, you can't double dip those with the employee retention credit. So to the extent that you've got wages in a given calendar quarter that weren't used for PPP forgiveness, you've got the potential to use those for the credit.
But let's take a step back. How much money could I get if I qualify for this retention tax credit? How much money could I get back?
So for 2020, you are eligible for a credit up to $5,000 per employee. This is the dream scenario. This is the max that you could claim per employee, but it's geared towards businesses that
per employee per quarter, right, Shane?
For the 2020 year, it's just per year. However, for 2021, they recently expanded it, I should clarify. So the cap for per employee has been raised from 5,000 to 7,000 for 2021. And instead of per year, which was the case in 2020, it is now per quarter in 2021. But it's worth noting before we kind of jump the gun in terms of asking, if I qualify for 2020, does that mean I get it for 2021? The income thresholds in terms of like the amount of loss you're suffering compared to 2019, it's gotten a little bit stricter with 2021. The credits at this point is geared more towards those that are still hurting. But the key thing is, even if you're not eligible for the 2021 credit, you still might be eligible for the 2020 credit and can claim it on an amended Form 941X.
Okay, so just to be clear, I just want to make sure I understand this. We could get $5,000 if we're eligible, $5,000 per employee in 2020 and up to $28,000 per employee in 2021 as an employment retention tax credit. And those are tax credits, right? So those are dollar for dollar reduction or even money back. Is that right? Against my payroll taxes?
So for now, from what I understand, the 2021 credit's been extended for Q1 and Q2 of 2021. Which would mean as of right now, unless there's been an extension passed for that, it would be $14,000 max for 2021 as of right now. Congress could come out and say, hey, we want to make for the entire year. So it would extend until like every single quarter of 2021, and then it would be that huge amount. That's if they pass that extension. So we'll wait and see.
Okay, all right. Well, let's dive into a little bit. So how am I eligible? Or what is the eligibility requirement? And is it black and white? I mean, I've heard so many things going back and forth on this thing. So where does your expertise kind of land on this, Shane? What's your opinion on who should investigate this? And then who is clearly in the 100%, yes, you qualify, and who maybe is in the gray area, just so we can help our listeners out in terms of should they actually take the time to do this?
Yeah, so the big thing with the employee retention credit, there's two parts. First of all, it's determining if you were an eligible employer, and then if you were, did you pay qualified wages? Those are the two big things in that flowchart handout that we have. The 2 pages focus on those 2 aspects, because once you have those satisfied, that's when it's time to get calculating. But for starters, you might be wondering, okay, how the heck am I an eligible employer? So the big thing with that is you're going to have to look to see at your revenue loss or at your losses between 2020 for a given calendar quarter versus 2019. And so the amount of expenses that you could take in 2020, by the way, for the 2020 credit, the kicker was March 13th. So basically qualified wages paid from March 13th through December 31st, those are potentially in scope for the employee retention credit. And so if you've had a greater than 50% decline in gross receipts for a given calendar quarter in 2020 versus 2019, you sound like you're in the running to be considered an eligible employer. Now, if you have more than 100 employees, the rules change for how the expenses work. If you have more than 100 employees, the logic's supposed to be you paid them to stay home during the leave. Whereas if you're a small employer, less than 100 employees, it's basically any wages that got paid out. And so even if you didn't have the decline in gross receipts, there is another way you could potentially still be an eligible employer. And this is the other thing that you should consider. Even if you haven't necessarily had the gross receipts hit during COVID, if you had a partial or full shutdown as the result of a government order, or your business has been substantially impacted, like say, for example, you weren't able to conduct business because your sole supplier was shut down due to a government order, then you are in the running to be an eligible employer. That's times where you really need to be considering if you're eligible for the employee retention.
So I had an issue with this yesterday with a client, and he asked me, and I didn't have the right answer, or I didn't have an answer. I told him I was going to have to figure it out. He had a European supplier that was 100% shut down because he couldn't import goods from Europe due to the government shutdown. He wasn't shut down, but the supplier was shut down, so he couldn't get supplies. So effectively, for 2 months last year, he had to shut down. What does that qualify then for this employment retention tax credit?
It sounds like he's in the running to be considered an eligible employer because due to a government order, he was unable to conduct his business because a key supplier was shut down. So I think at that point, you've got to look at your qualified wages and start thinking about, okay, if I've satisfied the threshold, how many quarters did I satisfy it for? Like how many quarters am I an eligible employer? Because it's determined at the quarterly level. It's possible to be one in one quarter of 2020 and to stop being one in another quarter of 2020. But it's within those buckets that you're able to determine, okay, qualified wages paid during this period might be eligible for the credit.
But at the end of the day, this opens up a whole different group of businesses that might not have been in fact shut down by the government, but shut down the government shut down a supplier or a supply chain or something that might open up the window to those who might be eligible, even if they didn't experience revenue declines of that 20% or greater in a quarter. Okay, well, that's fascinating stuff, Shane. We've got a few questions coming through on the chat regarding this stuff, but I'm going to come back to those at the end here to make sure that we're getting these questions answered because I think they're good ones. But Janine, you're up.
Hello.
One of the huge expansions in this bill, and then they re-upped the funding, which I thought was interesting, is for SBA loans. And so
Yes.
they put a tremendous amount of money into the SBA loans. And one thing I found fascinating is this SBA 504 program, which is basically owner-occupied property loans. Sorry, let me say this a different way. Loans for the purchase or the refinance of owner-occupied property, defined as like what, 51%? Is that right? You have to occupy?
Correct. So the SBA 504 loan program, it's existed before the stimulus bill was passed. And it's made for major business purchases, whether that's real estate or long-term machinery. But then, yes, as you say, it kind of got sweetened where it's now possible to use it for refinancing as well.
Yeah, in the old rules, you couldn't refinance even an SBA loan with an SBA loan. Now you can. What else is making this 504 program so attractive today as compared to, say, a year ago? Before we had the stimulus?
So on top of the ability to refinance an existing mortgage on commercial property, there's also some reduction in the loan fees right now. It doesn't mean that there are no loan fees to get this done right now, but there's a reduction there. And then originally they came through and said the SBA is going to cover up to 6 months of your payments for free. So not even a deferral of those payments, but those payments would be covered by the SBA as if you had paid them. That's since been shortened to 3 months. However, it's still a big plus for taking on the loan right now. And then on top of this, we're seeing in certain markets, just availability of more office space, just due to more folks working from home. So it's might be a good time to just look at this real estate that you might not have considered previously.
Yeah, and so what do the terms of the loan look like?
Yeah,
because that's
so
the other thing that I find so fascinating with this.
Yeah, the way that the SBA 504 loan works is it's held between the SBA and then a bank. And so it's sort of a blended rate and blended terms between the two sides. On the SBA side, you have sort of a decreased interest rate compared to market rates. And then on top of that, it's a 25-year fixed loan. And so you have a really long-term and fixed across that whole period of time. And we're grabbing this moment in time when interest rates are pretty low and extending that out for 25 years. Now on the bank side, the terms can look a little bit different depending on the bank and what they're going to offer, but I'm also seeing an amortization of 25 years on many of the LOIs I've seen so far.
So Janine, with your clients, what sort of interest rates are you seeing at the SBA side, and what sort of interest rates are you seeing at the bank side, so that we can get to kind of a blended understanding? Because I think for a lot of folks, this is pretty important stuff.
Sure. So right now, the current rate on the SBA side is 3.04%. And I can't promise that that's going to be the rate if you were to go get started on that now, because it does fluctuate somewhat, but that's where it's sitting on the SBA side. And then from what I've seen on the bank side, it's kind of floating between 3.5–4%, depending on credit and everything else that you have, the other business you have at the bank, that type of thing.
Got it. So still very low from historical standpoints, and anything under 4% blended sounds like you can blend it for about 3.5%, something in that neighborhood. Is that what you're seeing?
Yes.
Yeah, 3.5% fixed for. And what do you have to put down if you're going to go buy a new property? What do you have to put down?
It's 10% down for a general use property. If you are looking for something very specific, like a car wash or something like that, where you can only use that physical property for one use, then you're going to be asked to put 15% down.
Got it. Okay. And then about how long does it take to get these, and how long is this thing gonna last?
So some of these, yeah. So some of the special features, like the payments being covered, is going to expire September 30th. And you should figure on it taking 30 to 45 days to submit your information, get qualified for the SBA to review. Even that part just takes 2 weeks minimum. So definitely start the application process while you're in the process of identifying a property if you're looking for something new.
Yeah, I really see this as if you're a business owner and you're in a lease, tell me what are the options if I've got a lease and I still have another 2 years on my lease. Is this something I should even consider, or should I just wait until I'm out of the lease?
I think everybody should look at this. If the other two things we've talked about, the PPP2 and the ERC, those are for when your business is declining, but this is an opportunity for folks. Business can be great, and this is an opportunity for you to really capitalize on that. Owning real estate is a great way to build wealth. And so, take a look at the terms of your lease, take a look at the termination clause. Maybe it's not as bad as you think. Maybe it's a good time to get an attorney to take a look and see how you can negotiate your way out of that. And I think also taking a look at what the property that you might be considering would cost on a monthly basis. I have a client who's looking at this right now, and I think they're going to be able to save about $10,000 a month cash, because just the terms of the loan and the high rates they're paying on their rent right now make this a very attractive move for them.
Yeah, I know we were looking at a client this morning who's paying just about $100,000 a month in rent. And if we actually went to buying those two buildings, which we could do underneath this SBA program, I think we would cut that rent in half, which is pretty amazing. And we'd be paying it to ourselves. So
you're able to build that equity with a payment, and you're still able to deduct the interest and then the depreciation on the building for tax purposes. So that's really can be beneficial.
Yeah, it's pretty amazing with this. Now, when it comes to qualifications, what happens if business was down during COVID? Can I still qualify?
Yes. So they're going to be looking for a few years worth of history and also a forecast looking forward. Right now, what I'm seeing is the applications are also looking for information on how your business has been sustained through COVID. And there's sort of three aspects of what they're going to be looking at during your application. First of all, how is your business cash flowing? How is it projected to produce cash flow in the future? So they're going to look at that foremost. Next, they are going to be leaning on the appraisal of the real estate. So you're not going to be able to get a loan for way more than what the property value is, and they're going to hold that as collateral. And finally, it will require a personal guarantee, so expect to have your personal financials examined as well.
Yeah, I think what's unique about now versus in the past, from what I've heard from our folks at the CDC, is that they are weighing and putting a lot of value in projections. So even if you had a bad 2020, your projections will matter, and it's not just pie in the sky stuff. They'll actually take them seriously because they understand kind of 2020 was tough. So takeaways that I hear you say, Janine, is everybody should be looking at this. We're talking about 3.5% money for 25 years, 10% down, or if we're refining a property, we can get 85% cash out. And historically, we're at an interest rate at 3.5% that after tax is costing people anywhere from 1.7 to 2% on an after-tax basis. So this is a lot of, and we get 3 months free paid principal and interest by the government. Is that right too?
So far.
So kind of a crazy scenario. And I think at least my interpretation of this is a once in a generational type of a wealth building opportunity for business owners. And so I'd really encourage people to take advantage of it. All right, we got a bunch of questions coming in, but what I'd like to do here before we start taking questions, which we'll do in about 5 minutes, is I want to mention some of the other things that have happened here in this stimulus stuff. For lack of a better term, because we've had 3 big packages plus a ton of edits from the SBA and Treasury. And I want to just talk about what's out there and what people might want to consider here for their businesses. So we talked about PPP1 and PPP2. The third thing on underneath the heading of forgivable loans is these disaster loan grants, not the disaster loans, but the disaster grants. In the latest stimulus bill, they came out, not in the very latest, sorry, the one from December. The IRS said, or the Congress said, excuse me, and IRS will have to follow it, that these grants up to $10,000 were not taxable. So this is really important stuff because they said PPP1 wasn't taxable for federal purposes, although we still don't have guidance from, for example, the state of California. Don't know whether they're going to tax them, but that's still up in the air. But these grants up to $10,000 were free money, and they opened the window back up. So if you didn't get a grant and you have a disaster loan and you qualify for that grant, up to $10,000 of free money sitting there to go and get. Then obviously your employees probably got direct payments in the form of stimulus packages or stimulus checks, excuse me. The next round should be going out this week and next week. So be aware of that because this may be an opportunity to talk to your employees about kind of what to do with those stimulus checks. Maybe to save them, put them in an IRA, things like that can make their financial security and their personal financial safety better and ultimately build the culture in your organization. Another thing that I thought was really important to discuss is deductions. So the meals deduction. Janine, I see you smiling. What happened with our meals deduction in the December stimulus package for 2021 and 2022?
Yeah, so normally the meals are slashed in half. You only get 50%, but they're bumping that up in 2021 to 100%.
Yeah, and I know they're doing this because they want restaurants to get going, but
Exactly.
But it's also pretty cool for the rest of us because if you want to take people out, your staff out, you want to take people out for marketing, whatever it is, as long as it's a business meal, you're going to get 100% deduction versus a 50% deduction, and that's a big difference. It's a big difference for a lot of people. We talked about the employment retention tax credit, but the other thing that happened here was there was extra money that was given, and this is an existing program, to R&D tax credits. Often people don't talk enough about the research and development tax credits, and in a lot of businesses, you'll find if you were doing things to try to go out and figure out whether there was a new potential product or a new potential market, that can be qualified as R&D. So you'll want to really look into this because it's a dollar for dollar reduction in your tax bill. And so we'll answer the questions on the employment retention tax credit that I see building up in the chat, but that's an important one. The other thing is some grants, the grants that came out of these last bills. The first one is a shuttered venue grant. So if if you run a ice skating rink or a movie theater or a stadium or whatever, and you had a shuttered venue, meaning they had to close you down, or we have a client who has restaurants inside of airports. If they shut the airport down for some period of time, you have the potential to be able to get a grant from the government, and that window opens April 8th. So want to be mindful of that timing. Also, if you were in a restaurant, there's another grant that came out, which is the restaurant revitalization grants. And that's up to $5 to $10 million per restaurant. It's not per location, but per company. If you have multiple locations, it's up to 10 million. If you have one location, it's up to $5 million in a restaurant revitalization grant. And we can obviously help you apply for those and get those done. There's still some ambiguity around how to apply. We're waiting on regulations, but that's a huge benefit if you were in the restaurant business. The other thing that is important here to note is tax credits for emergency paid sick leave all the way through September 30th of 2021. And it's up to $5,000 per employee. So up to $5,000 per employee, you could get a tax credit if one of your employees had to have emergency paid sick leave due to anything. It's not just due to COVID, but obviously that's what it was aimed at in the beginning. Cool, more stuff to come, believe it or not. We actually have an expansion of the disaster loans. So if you got an SBA disaster loan, it used to be $150,000 was your max that you could get. Well, they opened the window back up, and now the max you can get is $500,000, and the rate is at 3.75%. So they took the loans from $150,000 all the way to $500,000 at 3.75%, and the SBA has said that part of that loan might be forgivable. They have not created guidance on that yet, so we're waiting to see what they say about it. But I mean, wow, another expansion, extra money. What were some of the negatives? There's really only one huge negative, and that is that the unemployment benefits of $300 per week were extended all the way out to September 6th of 2021. And for some businesses, I have heard employers say to me that their employees don't want to come back to work because, well, they're already getting paid enough to stay home. In that case, it can make recruiting pretty tough. However, with all of these other benefits, I really want you guys as business owners to be thinking about what can I do in my business to take advantage of this once in a lifetime kind of a stimulus sort of scenario from the government. So huge, huge issues that are out there and huge opportunities. All right, let's start to dive into some of these questions, and I'm just going to go just straight up from the top down here. And Bonnie, this first one is for you. Is business insurance covered under the PPP funds? And I think what they're asking is, we know that 60% has to go to payroll, and there's 40% that at the time had the PPP1 had to go towards facility costs, but that got expanded with PPP2. What else does it cover, and is business insurance covered with those PPP2 funds?
Great question. Yes, it is covered. So what else is covered is covered operating expenditures, which is if you're looking at your income statement, anything that's in operating expenses is basically what you're going to want to look at there. Covered suppliers is going to be what you're paying for inventory, or if you're in construction, what you're paying your subcontractors that you need to pay to finish your jobs. So yes, included. And that's, like I said, I think one of the greatest benefits. And this also applies, guys, to PPP1 forgiveness, if you have not yet applied for that.
That's phenomenal, Bonnie. And you know what else it does is it dovetails into the next question we have about the employment retention tax credit, because it can shrink the time where we're using PPP funds. We can't double dip. So if we can use them for all these new things, we can actually shrink our time and then still be eligible for this employment retention tax credit. So this is a very specific question, but it is, if I had PPP1 to cover 5/20, meaning May of 2020 through October of 2020, then can I use wages paid in November and December 2020 for the employment tax credit? And Shane, that seems like the answer is yes, right?
Yeah, the big thing is assuming you qualify. So I guess like just a reminder, the test to see if you're in the running for eligible employer, aside from government ordered full or partial shutdown, or if something upstream from your business happened that was impacted by that and you couldn't do business because of that, the other kicker is greater than or equal to 50% decline in gross receipts. Once that starts for a given quarter, you're still an eligible employer up until you've had a 80% or greater recovery in your gross receipts. So basically you have to have, from that moment you got that 50% dip, you've got to make sure that you still have at least a 20% decline. And if you've got that satisfied for Q4 of 2020, then yes, any wages that you did not use for PPP forgiveness or for the qualified leave credit under the Families First Coronavirus Response Act, those should be in the running for basically employee retention credit qualified wages.
I just want to pipe up as well to take a look at March 13 to the date when you receive the PPP funds, because if you were eligible in that quarter as well, you can have a little window at the beginning and a little window at the end if you're eligible.
That's a really good point, isn't it? Because if this person, for example, didn't get their PPP funds until May of 2020, we had from March to May to be eligible for that tax credit as well. Does that tax credit affect, how does it affect Social Security benefits for employees? I don't know. I don't know if that means benefits being received. I'm guessing it means Social Security taxes. So
there's an interaction between the two. I guess let me go ahead and clarify that. So the key thing is, because the employee retention credit, here's how it works. It becomes refundable to the extent that you don't have any Social Security tax liability. And so one of the big things with that also is, say, for example, you've got several employees, and remember that the cap is $5,000 per employee, and it's 50% of qualified wages. So say you run into that cap in, say, Q3 for a given employee, like you've hit the 5,000 max just for that employee. What could happen is maybe you've got like some liability in a subsequent quarter, some Social Security tax liability. And Investopedia actually has a great breakout on this that can probably make this a bit more digestible. The key thing is it does not impact Social Security taxes for employees, but there is an interaction that there is a potential limitation that goes on depending on your Social Security taxes versus what you're trying to claim in the employee retention credit. The key thing is that once you have that cap come in, you might have a limitation as a result of the Social Security taxes.
Okay, super complicated, but ultimately there's a lot in there. I think that is the important part for everybody to kind of take away here is we've got to understand that this employment retention tax credit has tons of twists and turns. And so at least take a look at it. If your government if you had a government shutdown. Now, one of the questions was, does this, if your supplier was shut down, do they have to be a sole supplier or just a key supplier in order for you to be eligible for that employment retention tax credit?
So basically, if it's a key supplier, I take that to that being a key supplier in the sense that you can't do your business without them. Now, if that's not the case, you're still able to conduct some business even with that upstream impact from the government order. You might be in the running for the gross receipts perspective, because it sounds like if you've got enough of your suppliers and your business impacted indirectly by government order, your gross receipts might take a big enough decline versus a given quarter in 2019 that you'd be in the running for being an eligible employer just based on that.
So
I would also say,
then go ahead, sorry, Bonnie.
I was going to say, I would also use, build your case in this, so use your CFO, use your accounting team to show data of what the impact is of, not being able to work with that supplier on sales, on continuing the business, and really build the case.
Yeah, that's a good point, because I think really there is some room for interpretation in this. What is a key supplier? What is a sole supplier? All of these things. And I would personally rather over deduct and take a slightly more aggressive position and have them come back and say, no, you owe the taxes back. Don't ever commit fraud. Don't ever lie or cheat or steal. But if you've got the data to back it up, at least make the argument. I think that's kind of your point, Bonnie, and it's a point well taken. Is the employment retention credit, is that tax-free for federal and California? Meaning, are you going to get a California, state income tax or payroll tax deduction as well, or credit as well?
So this is a federal program, just an FYI, and just an FYI too. Federal tax refunds. You might be wondering, okay, if I get that money back, do I have to declare it as income in a subsequent tax return? The answer is no. Federal tax refunds are non-taxable at the federal level. As for California specifically, I'd have to double check to see specifically to the state of California, because this is a federal program. That's what my analysis is focused on. For any state tax impacts, I'd be happy to do a further look if interested.
Got it. Okay, well, that's a good one. Janine, we're going to focus this one on you. If your company was down during COVID, we talked a little bit about this, but back up now, do you still qualify for the 504?
I would say it depends. So how is your business cash flowing now? They're going to look not just in 2020, they're going to look a couple years back to see how your business was managed previously, but also what's your forecast moving forward? What is, if you were to purchase a building, expand your business, what does that outlook look like for your business? And even if you showed a loss, how were you able to sustain during that period? What changes did you make? How did you adapt in that environment? Are all questions that the bank and the CDC, who's working through to get the loan over to the SBA, those are questions that they're going to ask. So you have more of an opportunity to explain it. It's an expected sort of situation for a lot of businesses that banks and the SBA are more willing to work with right now. But it's not just a guaranteed yes or no answer on that.
So something to take a look at for sure. Okay, well, let's get into another retention and tax credit question here. They say we're a child care provider. Given the government has shut down several offices, so that sounds like a government mandated shutdown, Shane.
Yeah.
Folks not able to come to work and hence not to bring their children to our facility. Would that be considered a partially suspended governmental order?
Yeah, so if you've had some of your locations shut down by a governmental order, that would be considered a partial government shutdown. I actually have a restaurant client that it looks like they might have had some of that happen with some of their locations, maybe not necessarily every location, but that's a partial shutdown.
What about if the customers are not able to come? Because here it sounds like the parents aren't bringing the children, even though they are open for business.
That's a good question.
So at that point, I believe that if you're not shut down yourself, the key thing is to look at the gross receipts then, because if your business has been impacted so severely by this, which it sounds like it has, I think you're strongly in the running for being an eligible employer just based on the greater than or equal to 50% decline of gross receipts for a given calendar quarter in 2020.
Yeah, lots of twists and turns in here, but good stuff. All right, here's another one. We have about 25 employees. Just from my rough estimate for Q1 2021, the retention tax credit is 70% of paid wages, capped at 7,000. Potentially, we could get 175,000 tax credit for Q1. We normally pay 80,000 in payroll tax per quarter. Is this right? Since we can get more credit than we pay, basically, we are looking at not having to pay payroll taxes for 2 quarters. Is that correct? Does that seem right, Shane?
So I just wanted to clarify in terms of how it goes. There's a $5,000 cap per employee in 2020. That's for the year of 2020. And then for 2021, it's a $7,000 per quarter cap. So relating this back to like the question here, you can't really claim like a credit for Social Security taxes that's greater than what you would have paid on them. That's the gist of it, because it's supposed to be a refund of Social Security tax, if I'm understanding that correctly.
Yeah, I think that's the question. Could they drag it forward? Could it be applied to future payroll taxes?
It's determined on the quarter. That's to my understanding. So it'll, like, each quarter is kind of its own bucket. If you're wondering about how to claim it for 2020, you'd want to use Form 7200 if you wanted to do accelerated claiming of the credit, just as an FYI. Alternatively, you can use an amended Form 941X for that. And like, once you determine whether it's fully refundable or mix of refundable and non-refundable, you can potentially just elect to either have your future remittances of Social Security taxes to the IRS reduced by that amount for a given payroll quarter. Like when you're doing your 941, you can note that as an offset. Or you can do the claim aspect where it's basically money back in the bank as long as you don't have tax liability with the IRS.
And do they use business owners' salaries as a part of the calculation? Can you use salaries from the company's owners?
Yeah, that's correct. As a matter of fact, that restaurant client, one of the co-owners, he has some wages picked up in there. I mean, it's subject to the cap, of course. The key thing is you want to make sure that it's not what's called related individuals. Owners can use their salaries, but their families, if you have, for whatever reason, anything showing up in those payroll reports is going to families, you can't take those. That's the key thing. And there's kind of a list that the IRS has provided This is notice 2021-20. That's the source for a lot of the updated guidance that we just got, and part of why there's been so much clamor lately. The Treasury issued this very substantive guidance for tax year 2020. And so I guess for those interested, I'd be happy to provide a link to that too, like in the chat right now or after the session. I think it's a great resource for a lot of questions.
Yeah. So Shane, I think that's fabulous. Thank you for offering that. We'll make sure and post that when we send out the follow-up email to everybody, so that you've got that and got your contact information as well, Shane. Bonnie, this one's for you. Can you define gross receipts? Is it different for cash basis or an accrual basis taxpayer?
There was lots of discussion on this topic, and where we landed was gross receipts should be however you are measuring revenue for the company. So if you are on a cash basis, use cash basis. If you are on accrual, use accrual. Whatever your income statement says for gross receipts. So there's some flexibility there.
Okay, but so do I need to, I guess I've got accrual basis financials. I file my taxes on a cash basis.
Mm-hmm.
Can I use either choice? Can I choose to call gross receipts either cash or accrual? Or do I have to pick one? Or do I have to use, like, is the government mandating one or the other?
My advice is to, in that situation, my advice is to use either. And I say this because if you're a business where your collection cycle is such that maybe your revenue reduction on the accrual method is like 20% and not quite 25, but when you're looking at your actual cash receipts that came in, that is 30% just based on timing of receivables and cash coming in. I would say look at both. If you're close, I would say look at both.
So again, this is another one of those scenarios where on the surface, it may not look like you're eligible for some of these programs because you didn't have the accrual basis reduction in revenue or gross receipts. But in fact, you may have had it because you may have had a cash collection difference in gross receipts that could qualify. So very important to have your accounting department look at both. That's great.
Mm-hmm.
Is that what I heard you say, Bonnie? Is that correct?
Exactly. Yeah. And accounting will definitely be helpful in this.
Okay, super. All right. Let's see here. We took over the business in September 2020. Can we still compare Q1 revenues with Q4? Janine, what do you think about this one? The key is we are a transfer. They're a business that looks like they bought a business and took over the reins in 2020, but it doesn't look like the business actually changed. It looks like the business, they may have bought stock or something like that. So it's still the same business.
That was my question, right? So if the business entity has been continued in operations over that time period, I would say, sure, still qualify. Looks like we just got more information. It was an asset purchase. So we've created a new entity, and I didn't change my advice. I don't think so.
So I think that's right, Jenny. I think if it was an asset purchase, then it starts the day you probably bought the assets, or right. And I don't think you might be able to start the day you actually set up the entity that you use to buy the assets. But we'd have to really dive deep with that one. I think that may be a little too technical for this, but there's some gray area in there on an asset purchase. On a stock purchase, for sure. It was probably, you could go back. Yeah, I know that makes sense. So, all right, let's talk a little bit about these disaster loans. One of the things that I want to talk about here is the expansion of these disaster loans from $150,000 to $500,000. Who would, in your guys' opinion, who should even consider these loans? They're at 3.75%. So they got a reasonable interest rate to them. But what if I don't need the money? What if who is the right person to consider these disaster loans and taking them again from the old $150,000 cap, taking advantage of the new $500,000 cap? When does this make sense to consider, Janine? I'll start with you.
I'm not sure if they've changed the eligibility standards for that, but if you qualify as being impacted by the COVID environment, even if you have that cash in the bank, if you have qualified as far as, being impacted in that way, definitely consider it.
Yeah. Shane, do you have an opinion on this?
don't, just knowing what I know about the employee retention credit, at this point, a lot of the relief that's being extended by the IRS is those that are continuing to hurt from coronavirus. And so some businesses that have like a better chance than others would be like the restaurant industry, for example. Like a lot of relief right now is being aimed towards those, like those that are really had their business impacted by not being able to have that physical presence for customer impact. I'd say in general, you've got a lot more opportunities with relief in general.
Got it. Bonnie, do you have any other thoughts on that?
Yeah, I mean, I think this definitely depends on how much debt you already have on your books and how much more you're willing to take on. I mean, I think it being a basically 30-year term loan is pretty favorable. So definitely something to consider. The payments are low, you know, over a long period of time. And I also think I'd have to look back at exactly what you can spend the money on. But if I recall, it has to be spent on basically operating type expenses. So if you're really behind on inventory and you need to build up stock and you've got purchase orders from clients coming in, and you know, you need to be able to buy that to meet the demand, like that's a situation that's coming up for me where you might want to look at this.
Yeah, I love that idea. The other thing to think about, Bonnie, is what if we got a 3.75% discount on buying $500,000 worth of inventory? We just paid for all of our inventory with somebody else's money. So we could actually, if it works for you, you could pre-buy inventory and try to get a discount for pre-buying the inventory. The other thing is to think about is that this is a pre-tax 3.75%. After tax, it's probably closer to a 2% effective rate for most taxpayers. So you're really only paying 2%. And I would consider this for anyone who thinks they can go put money to work and do better than 2%. Because this is another situation where the government is showering us with some free money. And it might be time to really start to think about this. Let's see, there's another couple of questions. Are there any plans to be able to get more money from the EIDL program if you already got an EIDL loan? Yes, so that's exactly what we're talking about. The EIDL loan used to be, the cap was $150,000. The new cap is $500,000. So you can go back and actually expand it by, even if you took the full 150, you can get another $350,000 in that EIDL loans. So again, I think Bonnie and Shane and Janine's advice is spot on, which is you really want to consider your debt load, consider your business plan and what you're doing. But ultimately, at the end of the day, if you think you can go out and use this to make more money with the government's money, that's a good idea and a good way to expand your business. All right, let's see. One last question, and then I need to wrap it up. And if there's any other future questions, we're going to put our contact information in here. You guys are welcome to reach out to us. We're happy to help. This is what we love to do. We love to help people. We love to use our, use Shane and Bonnie and Janine's big brains to apply some of these really crazy things to your businesses. But let's answer this last one. We're a church, which we do a lot of nonprofit work. In fact, have a couple of churches as clients. We shut down starting March 14th, 2020, and started online services. Then we opened up our campus for in-person service starting September 2020, but at less than 20% capacity. We are a qualified employer for the Employment Retention Tax Credit, with our operation partly closed due to the government order, right? I like the question at the end of that. Janine, what are your thoughts on this?
Yes, nonprofits qualify, and this sounds like a pretty easy case of government partial or full shutdown. It even describes situations where if your hours are limited based on some kind of government order during this time frame, that even qualifies. So yes, definitely look into it.
Awesome. Awesome. All right. Well, our last comment is, I think, the best, which he said, you guys are awesome. And I would agree. I am so lucky to have Janine and Shane and Bonnie on our team. These folks who love and get passionate about some of these things that don't seem like they're big deals until you actually put pen to paper and you realize how much money you can make on these things. You think about the PPP, it's all free money. Getting eligible, getting forgiveness, so important. It's all non-taxable. What Bonnie talked about, with what Shane talked about, you can get up to $5,000 per employee for 2020 and up to $7,000 per employee per quarter for 2021 on this employment retention tax credit. That's a ton of money. What Janine's talking about, creating long-term wealth with 25-year fixed money at 3.5%, buying your own business, paying yourself your own rent, getting out of those terrible leases that you were in and moving in a positive direction. So much exciting stuff into this. And I just want to thank Janine, Bonnie, and Shane for their excellent work today and expertise in this, and all the effort that you've put in and the hours and hours you put in studying this stuff to be able to deliver and fulfill on our purpose and our mission of making our business owners' lives better. So thank you very much. Last but not least, I've got a real quick notification for everybody who's out there. We have, let's see, there's the TGG Analytics. We're really excited to introduce TGG Analytics. We are going to be automating financial statements through QuickBooks at the start and then expanding to other accounting programs. And that is the TGG way, renowned financial statements. We have an amazing format that has been developed over the last 15 years that's proprietary and that typically costs $2,500 to $3,000 a month just to put your financials into that order. We're going to be doing it at less than $200 a month for clients. If this is something you're interested in being a beta tester on or getting in early, we'll get you a discount for getting in early. Our first online product, again, is going to allow you to connect to the accounting software, create an easy to read, easy to distribute, easy to comprehend financial statements online, fully in the cloud. And then based on your industry, we'll recommend a chart of accounts. We'll have benchmarking, all sorts of fun stuff. So you can see all your business performance in one spot. If you want to sign up for the waitlist, we will give you your first 3 months for free of this program. And you can sign up for the waitlist on tgganalytics.com. It's there on the screen, tgganalytics.com. And the last thing that I want to talk about here is TGG University. This last year, we launched TGG University. Our mission, again, is to make business owners' lives better through excellent financial management. The way to do that is to educate business owners, educate staff, and make sure that accounting and the accounting quality is up in small business across the board. So we have certificate programs, for all levels of accountants, whether they're at the data entry staff level, the accounting manager level, controller level, CFO level. We have TGG Way certificate programs launched. And we focus on asking, look, why are we doing this? And how does what we do as accountants benefit overall the business? And our instructors, again, are professional accountants, folks like Janine and Shane and Bonnie. Bonnie has taught some of our classes, and I know she's phenomenal. So if you have a team, we can develop custom training internally for you. Visit us at tggu.com for more information. And very last but not least, you'll see that if you're still looking for PPP forgiveness, stuff that Bonnie talked about, we do have a forgiveness tracker on our website. And if you use the code Bonfire Chat, you'll get a 50% discount off of our tracker so that you can make sure you maximize your forgiveness and, again, get that tax-free money from the government. Last but not least, if you put your email into the chat to the panelists, you'll get a complimentary 30-minute consultation with a TGG expert on anything you want to talk about. We can review your financials for accuracy. We can look at the team that you've got and try to assess whether or not you're getting the information you want on time. And then we'll also look for any kind of immediate profit recommendations, whether it's some of this government stimulus stuff or whether it's just things that we notice that we think maybe you could do a little bit differently and make some more money, increase cash flow, increase the value of the business, increase safety in your company. Whew. All right. I want to thank everybody for attending. This has been phenomenal. We've gotten a lot of great information. Again, I want to thank Janine, Bonnie, and Shane for their expertise and time and energy that they put into this. A reminder, all you attendees will be receiving a recording of the webinar via email within the next 24 hours. We want to thank you for being a part of this. We want to thank you for being a part of our TGG family. Again, thank you all very much. We'll see you next time. Bye-bye.